Hello friends. Last week in my video, I explained to you what the Ides of March is, the middle of March, and why the month of March is crucial, and more importantly, why institutional traders and players would dominate sentiments. That worked out along expected lines, and both the headline indices fell. Now, in this week's video, I want to basically examine what we should expect the week ahead and possibly what's going to go out even further going forward. Can the markets actually see some kind of a pullback rally considering that it's March end and there would be that usual NAV propping? Hey, yes, there can be. Do remember the minute the majority of traders take it for granted that the market is going to do X, the market winds up by surprising them by doing Y. All right. So a little bit of a pullback rally, some amount of short covering can nudge prices significantly higher, especially when you see in my in-house exclusive indicators segment. I will explain to you why and what is happening. For now, let's dive right into our usual format of the video, and what you're seeing on your screen is the weekly market roundup. You're seeing the broader base Nifty 50 basically fell, and the Bank Nifty actually fell harder and faster due to the sheer weightage of 34.35% of banking and financial sector stocks in the Nifty. They dragged the Nifty itself lower. The US dollar index, the Dixie, continued to basically fall, and what you are seeing is the impact on bullion that saw safe haven buying. Now, bullion is something that I've explained to you in many videos as to why I'm bullish, and I've actually in my own videos and in interviews with other YouTubers, YouTube channels, media interviews, I've gone to the extent of saying why you should allocate up to 30% of your capital in bullion, if not higher. The hyperlinks to every referral video that I want you to watch is in the pinned comment below and in the description below this video. Do take the time and effort of watching those, please. Now, the US dollar index falling failed to lift up the prices of energy commodities. This is along the expected lines that I have been mentioning to you, that the rallies were due to seasonal nature and the expectation that OPEC would somehow revive oil and gas prices. They've been unable to do so. I've been telling you, apart from all the hype in the public domain, these markets are adequately supplied. The USD INR rose, which means the rupee weakened marginally against the dollar, even though the dollar itself is weakening against the global basket of currencies. The NSE market capitalization went down by 1.79%, which means the sell off was fairly broad based. The US headline indices fell uniformly, and that provided headwinds to our markets. Friends, I now come to our in-house indicators. I start with the MWPL. Let me remind you, I consider MWPL to be the leading do-it-yourself indicator that anybody can plot, and the data source for this MWPL is in a pinned comment below. Let us see what this chart is telling you. The weekly chart tells us that in the second week after expiry, we are at 32.43%. Now, since the MWPL indicates the extent of exposure utilized by traders as a percentage of total exposure allowed by SEBI, at 32.43, it is significantly lower than the second week after expiry of January, December, November. And what that tells you is that, hey, the retail guy appears to be cautious, he appears to be tired, he's basically not buying aggressively. Now, this is a weekly chart. The daily data is something that I update on my social media accounts. Please do connect with me there. And the hyperlinks to my social media accounts are in the pinned comment and in the description below this video. Now, friends, I come to the stock and index futures turnover for the week. This is data pertaining to three concurrent series. So, this is March, April, and May. What you're seeing is index futures turnover has hit multi month lows. Admittedly, the turnover is bound to be lower because last week was one trading session short, but in spite of that, even if you were to adjust it pro rata, the turnover has come down very sharply. So has the stock futures turnover. Now, that basically is a worry. Can declines on lower volumes be good news because the sell off lacks some kind of pressure? I don't think so. Take a look at this video. The hyperlink, like I said, to all my videos I want you to watch are below this description and in the pinned comment below. I have explained to you why volumes are important on the way up, but not half as important on the way down when prices are falling. So do check that video out, please. Now, friends, I come to the advanced decline ratio, which after the price is the most leading indicator of which way the winds are blowing. At 0.68 per advanced decline ratio, it tells you that there were 68 gaining stocks for every 100 losing stocks. Compare that to the prior week of 2.59, which tells you that 259 gainers for every 100 losers. I remember telling you that this lofty level is unsustainable because 2.5 times of advanced decline ratio is statistically not possible to sustain week after week, and sure enough, it's fallen. Now, for the bulls to be able to revive the markets, this advanced decline ratio must stay above 1.0, failing which bulls are on a sticky wicket. Do watch this data on end of the day basis on my social media accounts every day, please. Now, friends, I take a look at the basis. Basis is nothing but the premium or discount enjoyed by futures compared to the spot. Just like the options premium, basis also erodes as we approach expiry. But all other factors remaining constant, lower basis equals to low risk appetite and vice versa. What you are seeing is the basis for both the Nifty and the Bank Nifty prompt month future. The first month futures has come down by more than 50%. That is not exactly great news. Bulls refuse to pay a premium on fresh purchases. That tells you that they are postponing the buy decision. And that is reflected on the snap quote window where the bid and offer spreads are now way beyond 4 to 5 or even 6 tick prices. And that's not very good news. Those of my online family who've learned the subtle art of screen reading and the tick by tick data, which I've explained in a tick by tick video, would have basically noticed this immediately in the 4 trading sessions of the week gone by. Now, friends, I come to the impetus indicator, which is our in-house indicator, not available anywhere. It measures the momentum or the force in any move. Just see how the Bank Nifty has fallen with higher impetus, whereas the Nifty has fallen with lower impetus. Lower impetus means less of forceful selling pressure. But does it mean that the decline cannot continue? No, I don't say that. All I'm saying is that there was less force in selling on the Nifty as compared to the Bank Nifty, which saw higher force of a sell-off. Now I come to a lift weight thrust drag indicator, which you won't find anywhere on the internet. You've been trusting it for 4 years in a row and it stood the test of time. Now, last week we saw the indicator fall to minus 0.11, whereas the prior week it was plus 0.13. Now, even though it was plus, it was very marginally above zero at 0.13 in the week prior. And I told you that the buying support would be higher, but it would be fairly feeble or fairly limited. And sure enough, the buying support turned out to be feeble and the headline indices fell. Now, a reading of minus 0.11 tells you that in the week ahead, fresh buying may be even more limited compared to the week gone by. Short covering can happen anytime. Don't forget, this is March ending coming up. So mutual funds and high net worth individuals might pull up prices, but short covering can at best cushion the declines or even trigger a short covering rally, but it's not a complete trend reversal. So let's be careful out there. Friends, I now come to the bond market, and the weekly chart on your screen tells you that the Indian 10-year benchmark bond yields have performed relatively better as compared to some of the European markets. I've shared charts on my Telegram channel of France, Italy, Germany, England, and I've explained to you how this is leading to turbulence. But relatively speaking, we in India are seeing calmer 10-year benchmark bond yields. But do note how since the last 7 weeks there has been an unmistakable, slow but steady rise in the bond yields. Now, this is something I'm going to keep and advocate you also to keep a hawk eye on. If at all bond yields were to cross 6.90, I think the decline in equities might just accelerate. Friends, what do I make out of this bond yield and what is the way to go forward? For fixed income investors from my online family, keep the powder dry. I'm telling you to wait for yet another week after telling you to wait for many, many months. I'm not deploying money in gilt funds or in Indian 10-year sovereign benchmark bonds. I expect higher yields going forward. Now, friends, I come to the Bank Nifty, which, as you can see on the daily chart on your screen, has fallen on 3 out of 4 trading sessions, and it stayed below its month long moving average, which itself is sloping downwards, and that is a sign of weakness in the absolute near term. Look at the red trend line, which is a neckline of an unconventional head and shoulder pattern. The price is staying below the neckline, which tells you that there is clearly weakness in the undertone in the Bank Nifty. Don't forget, banking and financial stocks have a 34.35% weightage in the Nifty 50. So there's still a drag potentially in this index. Friends, I now go to the weekly chart, and the weekly chart on your screen tells you that a bearish candle was formed with a very small body, and there's been a slow grind downwards rather than an accelerated fall. Do remember, it was a short week, and the indices have witnessed narrow trading ranges. The price happens to be comfortably below the 25-week exponential moving average, which is equivalent to 6 months holding on cost of an average bull. Now, that tells you that the medium term outlook also remains nervous as of now. Unless the markets are able to trade above the 25-week exponential moving average and a round number of 50,000, I don't think the Bank Nifty is likely to see a sustained upthrust prior to that. Now, friends, in the week before last, this index was at number 17 on a statistical beta rankings of in-house volatility counters that I maintain in-house. It rose, or rather, it jumped to number 8. Now, that tells you that volatility actually spiked up, and that is not exactly good news for an average retail trader, because volatility is not something he or she is geared to handle very well. Friends, last week I estimated a range between 50,000 and 50 on the upside for this index and 46,950 on the downside. In spite of all the volatility, the range held very well. In the coming week, I estimate a range between 49,550 on the upsides and 46,550 on the downside. The range might appear wide to you, 3,000 points, but do remember statistical beta and standard deviation, which are two measures of volatility, are fairly high. So you need to give a big leeway. In addition to these ranges, please also watch our daily, weekly, monthly pivots that I update on our social media accounts, especially my Telegram channel. And also watch this video, which explains to you how you can utilize our pivot tables effectively for laser precise trading. Friends, the Bank Nifty done, I now come to the Nifty 50 index, and as the daily chart on your screen tells you, this index also fell on 3 out of 4 trading sessions last week. Its firmly contained within a bearish sloping channel, which is more than 6 months old now. Price remains below its month-long moving average, which itself is sloping downwards. So the near-term outlook remains nervous. Do remember what I told you at least twice before in this video. A short covering rally can occur anytime, but it's too premature to call that a complete trend reversal, because the channel top itself has to be overcome very, very sustainably and forcefully to be able to call a complete trend reversal. Friends, let's come to the weekly chart, and on your screen what you're seeing is a bearish candle with a small body contained within the prior week's bullish candle with a much larger body. This is an inside pattern. Outlook for an inside pattern is that of consolidation, indecision, and traders taking a breather. Normally, follow-up action determines what happens next. The price is significantly lower than the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. It's so far below the moving average that some amount of mean reversion could occur anytime. Now, whether there could be a price-wise correction upwards or a time-wise correction when the price goes sideways and the average attempts to catch up with the price, that time will tell. But the possibility of a technical rebound always exists. Last week I had advocated that this index needed to trade about 23,200 before you can go out there and write a check on the buy side. I still maintain that view that it's kind of premature to call this a sustainable up move, even if the market was to rise. Last week, this index was number 18 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It jumped 2 notches to number 16. Here again, volatility went up. Now, last week I advocated an estimated range between 23,150 on the upside and 21,950 on the downside, which held perfectly well thanks to a narrow range. In the coming week, I estimate a range between 22,950 on the upside and 21,850 on the downside. In addition to these ranges, do also take note of daily, weekly, monthly pivots, as well as the video on how to use our pivot tables so as to laser precise your trading entry and exits. Friends, I now come to the last bit of statistical analysis, wherein I share my views on the retail risk appetite. What you are seeing on the weekly chart on your screen is that the futures segment, both index and stock futures, turnover contribution to the F&O space fell. Index futures turnover fell by 3 basis points, indicated as the blue line, and stock futures turnover contribution fell by 7 basis points, indicated as a red line. Now, futures demand more span margin, they are more volatile, delta is higher than options, and therefore are more capital intensive and more volatile. The fact that turnover has fallen there, it tells you that traders were bullish, optimistic, but very cautiously. Why were they optimistic? Because the turnover went up in index options segment. Now, options are relatively less demanding where capital is concerned and tend to be less volatile because delta is rarely 1. It's always below 1 most of the times. So, out of index and stock options, index options are a whole lot less demanding and volatile, and therefore bulls were buying, going long, but in the least risky instrument. That tells me that risk appetite has fallen off a mountain. And unless risk appetite actually goes up, I think this market is appearing to be extremely nervous. Friends, I now come to my trading strategy for the week ahead. I think this week is going to be rather quiet. I could be surprised, of course, because the market might just decide to kind of display a high burst of energy in either direction. But from the data that I have analyzed so far, I don't see any reason why I should tweak and turn my trading strategy of theta decay in interest rate sensitives in public sector units, which are seeing higher than average participation levels, both because MWPL is still relatively elevated and traders are still nursing a lot of emotional and financial commitments on these stocks. I will, of course, continue to focus on power and energy thanks to whatever is happening in the energy commodity space. Where industrial metals are concerned, higher levels are encountering resistance, though due to the Trump tariff decisions, industrial metals are inching higher, but at higher levels they are expected to run into resistance, which means metal mining company stock prices have limited upsides. Now, where bullion is concerned, do remember I've made multiple videos on bullion, and I have also been telling you I favor physical bullion rather than electronic or ETF or in a bond route. Now, you're seeing why I have been telling you this. Now, there are always doubts, suspicions, fears whether the actual amount of bullion is there in Fort Knox in the US. There are WhatsApp forwards which you must have got about Bank of England facing shortages in physical bullion. So believe me, when you are protecting your capital in bullion, uh, it makes more sense to hold actual bullion rather than hold bullion in paper form, because you are trying to protect your capital from paper assets, and therefore protecting your capital in paper form of gold or silver doesn't make as much sense. Now, friends, I would talk about energy. I think theta decay on energy counters remains a plausible strategy here. The other aspect that I think you might need to watch out for is the small and mid cap segment. This has been beaten down, and it's basically witnessing signs of extreme amount of volatility build up. Now, prices might just get a little too aggressive, and if you're risk averse, you might, if you are a trader, want to curtail exposure on intraday trades. I'm referring purely to traders, not to investors. Please note, you might want to trade light on these counters. And whatever that you're trading, please do maintain stop losses, and also maintain tail risk hedges or Hacienda hedges, as I have advocated in the Hacienda hedge special video, which you can watch from the hyperlink below in the pinned comment below. Friends, if I have any more ideas, I would gladly share them on my social media accounts. Do take the time out to connect with me there. And before I sign out from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. I thank you for pushing us to 2,725 odd levels all India basis for our YouTube channel rankings. It's all due to your viewership attention that we have reached here without any paid services, without advertising or having any kind of digital marketing endeavors. Please do refer our channel and videos to your friends, family, and social media groups, etc., to help me reach out. Also, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how you find my videos and what I can record next to help you understand markets better. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.